Assalamu alaikum. This is the second video on translation of foreign affiliate financial statements. In this video, we will talk about the forward contract as a hedging instrument. First, we will explain the concept of hedging, derivative instruments, and forward contracts, and then we will solve an illustration and a problem on foreign currency transaction. But in the beginning of this session, I would like to thank my son Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories, without which making these videos would not have been possible. I would like to thank Nabia Khan for helping me out in preparing these awesome slides. I would like to thank my wife Samina for her care, encouragement, and constant support, who allowed me to use time for her in making this video. In the first video, it was explained that if a company does business around the world, it may experience currency risk. The currency exchange rate may change unfavorably when converting foreign currency back into domestic currency. Finance managers use hedging, also called hedging foreign exchange rate risk, to minimize or eliminate foreign exchange risk. Hedging is accomplished by purchasing an offsetting currency exposure. For example, if a company has a liability to deliver 1 million euros in 6 months, it can hedge this risk by entering into a contract to purchase 1 million euros on the same date, so that it can buy and sell in the same currency on the same date. Derivative instruments are used to hedge foreign exchange rate risk. Derivative instruments are not only for foreign currency, but derivative instruments are for many other financial assets such as stock, bonds, real estate, etc. In case of derivative instruments, if the prices go up, the firm can participate in those price increases. But if the prices go down, the firm can protect itself from the losses. These instruments can be classified into two broad categories: forward-based derivatives and option-based derivatives. In this video, we will talk about forward-based derivatives. Both forward and option-based derivatives work the same way. Both protect the firm from foreign currency exchange risk, but they have a different purpose. In case of forward contract, the firm buy or sell a specific amount of foreign currency at a specific date. So, there is a transaction that is to be protected by forward contract. Option based gives the option to buy or sell the option within the period and is more speculative than a forward contract. A forward exchange contract is an agreement to exchange currencies of two different countries at a specified rate on a stipulated future date. For example, a Saudi firm needs a specific amount of foreign currency in the future because the firm has purchased from a foreign country, say Germany. So the Saudi firm buy a forward contract to pay the German firm, or the Saudi firm sold to German firm and the Saudi firm receives euros, so it need to convert the euros into Saudi riyals. If the Saudi firm want the amount payable to be guaranteed rather than bear the exchange rate risk, then it will go for a forward contract. All commodities, be it crude oil or even food grains, go through a price fluctuation. The price of a barrel of crude oil may juggle between 50 today and rise to 65 next month, or may drop down to 30 a month after. These fluctuations often cause plenty of uncertainties for the businesses that depend on these commodities. Apart from uncertainties, such fluctuations in the prices induce a lot of speculations. Companies that trade such commodities would want to leverage the dynamic prices and often use a type of financial derivative called forward contract to buy or sell them. A currency forward deal works in the same way as any other forward deal, except that instead of a commodity, the currency is traded on a future date on a foreign exchange market. The exchange rate is logged at the time of signing the contract, and hence market fluctuations don't have an impact on it. Unlike other derivatives, like the exchange traded currency futures, parties can customize a currency forward contract to suit their needs. There are four kinds of forward contracts that can be used as a hedge: foreign currency transaction, unrecognized firm commitment, foreign currency denominated forecasted transaction, and net investment in foreign operations. First, a company can hedge foreign currency transaction. Second, the company can have unrecognized firm commitment. That means that the company enters into a contract to buy something in the future. So there is a firm commitment that the company will buy. It is called a fair value hedge. Third is called foreign currency denominated, which is forecasted transaction. Fourth is called cash flow hedge. Here the company has planned to buy something in the future and the company wants to protect its position. The difference between B and C is, in case of B, any gains and losses will be recorded in the income statement, while in C it is recorded into OCI, and then from OCI it is recorded in the income statement. Fifth, we have the net investment in foreign operation, and if a company has an investment in a foreign operation, then the investment can also be hedged. Forward contract could also be used for speculation, that means gambling, and in this case the firm is interested in the gains and the losses on the contract itself. It is not protecting anything. Let us now work on an illustration. On December 2010, the firm entered into a contract to purchase inventory for 500,000 euros. The spot rate is 1.05 on this date. So the firm will have a payable of 525,000. However, if the exchange rate increased to 1.07, the firm would be paying 535,000. On the other hand, if the exchange rate dropped to 1.02, the firm would only need to pay 510,000. Because the firm cannot perfectly estimate the change in the exchange rate, the company might prefer to eliminate this risk by entering into a forward contract to buy euros on March 1, 2011. Now, since the forward rate on December 1 to purchase euros on March 2011 is 1.052, the company can buy 500,000 euros on March 1 for a guaranteed price of 526,000. This fixed price means the firm has determined in advance the amount of loss it will suffer, and in this case 526 minus 525 is equal to 1000. Thus, the firm is protected from future increase in the exchange rate above 1.052. By locking into a set price, the firm gains if the spot rate on March 1 increases above 1.052 and loses if the spot rate decreases below 1.052. The important point to note about the hedge is that the firm knows with certainty on December 1, 2010, the amount of cash needed to purchase the asset. The entry to record the purchase and forward exchange contract are as follows. Purchase is debit and accounts payable is credit. 500,000 euros times the spot rate 1.05, and for the forward contract it is 500,000 times 1.052, that is equal to 526,000. At the date of the transaction, the US firm recorded the forward contract by recognizing a payable of 526,000 and a receivable of 526,000 for the number of dollars to be paid. The net value of the forward contract is 0 since the payable and receivable are exactly offset. The value of the receivable from the dealer and the account payable for the purchase of inventory are subject to changes in the exchange rate, but the gains and losses generally offset each other since the terms and the amounts are equal. On December 31, the spot rate increases from 1.05 to 1.055, resulting in an increase of 2,500 of accounts payable. So we will look into this transaction to be recorded on 31st December in the next slide. But before that, I have recorded these journal entries into these T accounts. Purchase is 525 and accounts payable is 525 in the credit. Foreign currency receivable from exchange dealer is debit and payable is credit. Now on December 31, the balance sheet date, the spot rate increases from 1.05 to 1.055. That means there is an increase of 0.005, and times 500,000 will give us a loss of 2,500. Now this is a loss because there is a payable and our payable increases by this amount. So transaction loss is debit and accounts payable is credit. The forward rate also increases from 1.052 to 1.059. So there is an increase of 0.007 on total of 500,000 euros. But in this case, this is a gain for the business because this is a receivable. So our receivables increase by 3,500. So foreign currency receivable from exchange dealer is debit and transaction gain is credit, and I have recorded this in the T account as well. In addition, accounts payable would be recorded at the spot rate in the balance sheet. The income statement would report an exchange loss of 2,500 and 3,500 respectively. Now, on the settlement date, the spot rate again increases from 1.05 to 1.07. So the difference will be 0.015 times 500,000. So this will give us a transaction loss of 7,500. The forward rate on the settlement date will be the same as the spot rate, that is 1.07, and again you can see that the forward rate has also increased from 1.059 to 1.07. So there is an increase of 0.011 times 500,000. So that gives us 500,500. Now this is a receivable, so that's why we have a gain of 500,000. Now I would like to show you something interesting. If you look into the balances, in account payable, and foreign currency receivable is the same. The dollars payable to the dealer remains fixed, that is 526,000, and the reduction on the foreign currency payable. Also, the receivable is converted into the investment account in the foreign currency, representing the 500 euros already acquired in the forward contract. So, dollars payable to exchange dealer is settled by over here by paying cash of 526, and we receive the receivables now, and this is converted into investment. And finally, we are going to close the investment account by 535 and our accounts payable by an equivalent amount of 535. So by obtaining the forward contract, the firm was able to establish at the transaction date the amount of 526,000 that it would take to acquire the 500,000 euros needed to settle the account with the foreign firm. Note, however, that the cost of the inventory, that is 525,000, was established on December 1. If the forward contract has not been obtained, the firm would have paid 535,000 if they have not entered into a forward contract to set, and they would have reported a net loss of 10,000. The net gain from entering into the forward contract of 9,000 has reduced our losses from 10,000 to 1,000 only. Finally, let us solve a problem on hedging foreign exchange rate risk. Now, Crystal Exporting Company is a US wholesaler engaged in foreign trading. The company transaction is representative of its business dealings. The company uses periodic inventory system and is on a calendar year basis. All exchange rates are direct quotations. Now, on December 1, Crystal Exporting Company purchased merchandise from Chang Limited, a Hong Kong manufacturer. Notice that the transaction took place over here and this is not a commitment. The invoice was for 210,000. Payable on April 1. On the same date, Crystal Exporting Company acquired a forward contract to buy 210,000 Hong Kong dollars on April 1 for 0.1314. So let me show you what happens. 210,000 times 0.134 is 27,594. So Crystal Company logged this transaction for 27,594 as it does not want to bear the risk of unfavorable exchange rate risk on the settlement date. The spot rate and the forward rates for the Hong Kong dollar are as follows, and here is an additional information. we need to work through to record the transactions. So the spot rate on December 1 is 0.1265. On 31st December we have the spot rate, and on 1st April we have the spot rate. So the spot rate and the forward rates for the Hong Kong dollars are given in this table. Just keep in mind that Crystal purchased the forward contract on December 1. So there are two transactions on December 1. First, the transaction for the purchase, and second, the transaction for the hedge. Let us see how to record the purchase. Now, on 1st of December, Crystal purchased 210,000 worth of goods from the Hong Kong company. The spot rate is 0.1265. So the amount payable is 26,565. So Crystal records its purchase based on the spot rate, and on that same date, Crystal will record the transaction it has hedged. Now, hedging means the company wants to guarantee it has to pay for those Hong Kong dollars. So, it purchases a forward contract. Now, the Hong Kong dollars payable are 210,000. The forward rate is 0.1314. So the amount payable is 27,594. So we debit forward contract receivable, foreign currency receivable from exchange dealer debit, which is an asset, and credit the dollars payable to the exchange dealer, 27,594. Now just keep in mind that we are not going to touch the account dollars payable to exchange dealer, as this is a fixed figure. So Crystal Company will pay 27,594 US dollars for the dealer, as the dealer has promised to sell Crystal Company 210,000 of Hong Kong dollars at the rate of 0.1314. We can also say that 0.1314 US dollars is equal to 1 Hong Kong dollar. So Crystal has an asset and a liability when it enters into a forward contract. Crystal is ready to pay 27,594 US dollars to the dealer for the purchase worth 26,565. So it agrees to pay an additional 1,029 US dollars because it do not want to bear the unfavorable foreign exchange risk on the date of settlement. Let us see how this account looks like in the T account. So we have recorded the purchases on 1st of December, we have recorded the accounts payable, and then we record the foreign currency receivable and dollars payable to the exchange dealer on 1st of December. Now, accounts payable is the item that is hedged by the company, and foreign currency receivable from the exchange dealer is the hedge itself. So Crystal hedged its accounts payable by a forward contract. Next, we will keep track of the fluctuations of the accounts payable as well as the forward contract. We will check these fluctuations on the balance sheet date as well as on the settlement date. Now, on December 31st, the spot rate is 0.1259. On 1st of December, the spot rate was 0.1265. So the spot rate on 31st December has decreased by 0.0006. So the payable went down from 26,565 to 26,439. So the Crystal Company makes a transaction gain of 126 on the balance sheet date. And the general entry will be accounts payable debit by 126 and transaction gain credit by 126. So the spot rate on the balance sheet date worked in favor of Crystal. Let us see whether the fluctuations in the forward rate went in favor or against the company on the balance sheet date. The forward rate on the balance sheet date decreased from 0.1314 on 1st of December to 0.1308 on 31st December. So had Crystal Company waited for 31st December, they could have brought the forward contract. So how much is the difference? By 0.0006 US dollars cheaper. Now when generalizing, the account receivable will be reduced by 126 and transaction loss will be debited by 126. And the T account will be looking something like this. We have accounts payable debit by 126, we have a transaction gain credit by 126, then we have a transaction loss of 126 and foreign currency receivable from exchange dealer credit by 126. Let us see what happens on the settlement date. On 1st of April, the spot rate has gone up from to 0.1430 from 0.1259. So there is an increase of 0.0171. That means Crystal Company has to bear a loss of 0.0171 US dollars on each Hong Kong dollar payable, that will be equal to 3,591. So we have Hong Kong dollars and this is the rate on 1st of April. So payable is 30,030 and the payable was established on 31st December was 26,439. So there is a transaction loss of 3,591 and this will increase our liability. So transaction loss is debit and accounts payable is credit. Now let us see what happens in the forward contract. On the settlement date, the spot rate and the forward rate will be the same. So the foreign currency receivable from the exchange dealer will be 0.1430 times 210, that is again 30,030. It is the same. The foreign currency receivable from the exchange dealer on 31st December was 27,468. So there is a transaction gain of 2,562. So debit the receivables and credit the transaction gain. The T account will look something like this. You see, we have an account payable of 3,500. This was the balance on 1st of January, and we have on 1st of April we have a transaction loss of 3,591, increasing our account payable by 3,591. The foreign currency receivable has increased by 2,562. Dollars payable will be the same as we have already talked about. There is a further increase in our transaction gain of 2562 and there is a loss of 3561. Okay. So Crystal is responsible to pay $27,594 to the exchange dealer. So we will debit the dollars payable to the exchange dealer and we will credit cash by 27,594 to settle this account. Next, the forward contract receivable from exchange dealer will be replaced by investment. So forward contract receivable from exchange dealer is credit by 30,030 and investment is debit by 30,030. At the same time, the investment account will be replaced by accounts payable account and now investment account and accounts payable are gone. So this is how Crystal settled its foreign currency transaction, and let us look into the transaction summary on foreign exchange transaction. If Crystal Company has not entered into a forward contract, their accounts payable on December 1 would have been 26,565. This would have decreased to 26,439, making a gain of 126, and again increased to 30,030, making a loss of 3,591. So this means if the Crystal Company has not entered into a forward contract, they would have recorded a loss of 3,465 on this transaction. But because of the forward contract, on December 1, the forward contract receivable was 27,594. That decreased to 27,468. So there is a loss of 126. But on April 1, there is a gain of 2,562. So the net impact is that there is a gain of 2,436. So since they have entered into a forward contract, the transaction loss has reduced and the net effect is 1029 loss when forward contract is used. So this completes the second part of our explanation on foreign currency transaction. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Happy learning.